What's up, successful and soon-to-be successful traders? Chris Capri here, secondsguysforex.com. So welcome to take 2 of the large and small corrective structures video. Why do I mean take 2? Because we recorded a version earlier and somehow sound kind of gave out for a little bit, not really sure why, and it was in the raw file. It wasn't just in the recording, but the raw file. And so my video editor came back on this week on Thursday. He said, hey, you got a problem. So we had to redo the video, and that's this video. Now, in some sense, there's actually an upside to this because the original video was quite long. It was about 20-something, 25, 26 slides, roughly. And it was, well into an hour. And it's just, I think for a webinar, that's fine. But for a pure lesson where there's just, information, different than a webinar where there's Q&A and pauses and maybe go to the bathroom in the middle of it. The lesson is just pounding with information. And so I thought, okay, well, maybe I need to redo this. So we decided to split large and small corrective structures into 2 parts. We kind of want to lay the foundation in this video and start to think about corrective structures in a much more nuanced fashion. And so you start to see kind of more of the subtler details, the beginnings of the subtle details behind large and small corrective structures. So think of this as an expansion of price action context and price action structures. And so we're going to, in this video, we're going to talk about the types of core corrective structures, the sizes that we work with, and kind of give some examples of them, and then kind of talk about the order behind them. So let's kind of get into. So starting off with the types of corrective structures, this is something we mentioned before, and I kind of want to reinforce it because some people seem to forget about this. So there are with trend corrective structures, there are horizontal corrective structures, and there are counter trend corrective structures. And so just to kind of reiterate what those are, we have in this chart here in the US dollar 1 hour time frame. So a with trend corrective structure would be kind of this move right here. This would also be a with trend corrective structure. This, in the context of this move, it's with trend. In the context of this move, it's not, it's counter trend. But in the context of this move, it is with trend. So these are with trend corrective structures. You might recognize one type of with trend corrective structure, and the first one there, and that's a pre-breakout. It's a pre-breakout structure you should see there. So that is a type of with trend corrective structure. And so let's see, is there anything else I wanted to say about the with trend in this one here? Because I got the horizontal and the other one's the other one. In terms of the order flow that tends to be behind with trend corrective structures, so we already understand the order flow behind breakouts. For those of you who have done the breakout section. Sometimes corrective structures with trend can be kind of like an accumulation, not in the early phases, but more of like short term, we've had a sell up and the buyers are just kind of accumulating, or absorbing would be another word for it. In this case, it'd be more of kind of absorbing price action. So it's where, in this case, the bulls are absorbing the offers, the bids are absorbing the offers, and they're kind of bleeding and starting to wear down some of these, these offers that are still trying to, take it to another level. So that would be an example of that. Profit taking, if sometimes the majority of the time profit taking is going to be horizontal or counter trend corrective pullback, but there will be times in that there's profit taking, there's just no resistance on the other side of the market, or perhaps maybe there is a small corrective structure before a major resistance zone. So it's not like pushing heavy because the bulls are hesitant in that case, but the other side of it is that the next, the bears in this case aren't really present until higher up. So it's just kind of slowly bleeding into it, testing the waters to kind of see what's there. So those would be types of with trend corrective structures. Horizontal corrective structures, looking at the same chart right here, would be this green box. This is your classic or your traditional corrective structure here. It's just straight horizontal. It's at the top of the impulsive move, which suggests bulls are in control, which suggests the most probable scenario from here, because remember, we're thinking in probabilities. The most probable scenario from here is to the upside. It continues this move: impulsive, corrective, impulsive, counter, impulsive, corrective, impulsive, corrective. This is the next most likely direction, upward. So with that being said, horizontal corrective structure, a counter trend corrective structure. In this case, it would be counter trend because up till this point, the bulls are in control. This would be horizontal here. It's got a little bit of a counter trend in terms of this move, but it's mostly horizontal. And so those are types of counter trend corrective structures. Now, one thing I want to say about horizontal corrective structures are stable. Those are the easiest to attack. With trend are a little bit trickier unless they're a breakout, then it's very clear. Counter trend is the hardest between all of them. It's the hardest because we don't know when the market's going to stop and pull back, and it could be a 20 MA, it could be prior RRL or LLT or resistance zones. You know, it could be any one of those things that maybe at EMA on a higher time frame. So we don't know when it's going to end. If we're looking to buy this corrective pullback with trend, the market short term is against us, even though medium term and long term is with us. This corrective structure counter trend means short term the bull or the bears are in control. So if we're buying into that, we're buying into a small, not too aggressive order flow environment that's slightly against us. So we have to understand that, what we're getting into. It also means that until this is kind of stabilized, we're trading against the market to some degree, at least in the short term. So counter trends are the hardest. They take the longest to learn to master. The horizontal is the easiest, counter trend is the hardest, and with trend are kind of in the middle. The direction's not too hard. It's more of the timing that makes the with trend corrective structures hard. Horizontal ones are really easy. You don't necessarily have to worry about the timing because it's all about the structure. As long as the structure holds, you can get in here, 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 here. It doesn't matter. The only thing it's going to test is your patience, but there's nothing in this price action that's posting against you. So it should be one of those things where if you really are aware of your thoughts and your emotions in that moment, that you're able to manage them and say, yeah, I'm sticking with this. It's just taking a little bit longer. So, you know, in the beginning, you want to practice the horizontal ones first, you know, especially if you're going to work on and trading these in Forex Tester 2 or simulation trading. If you are after this, then you want to work on with trend corrective structures, and then after this, you want to work on counter trend corrective structures. Those will always be the hardest, and it's not that one necessarily offers you more profitability than the other. There can be millions and millions of with trend, horizontal, and counter trend corrective structures that can offer massive profitability or not. It's not that one is more dominant than the other and one will automatically. They will all offer equal opportunities in terms of profitability. If you had to measure it out, it would, you know, it'd be pretty even across the board. So don't try and think of it as which one's more profitable. Try and think of it in terms of which one is best for you and your particular style. And that, you know, you should understand after, you know, 50, 100, 150 trades, maybe 500. After a while, you're going to start to be like, okay, I do well in these, I don't do well in these, and this one feels most natural to me. I like to buy pullback, or I like to buy horizontal, or I like to buy the breakout. It doesn't matter. Pick your own style, one that feels natural to you, and that's the one you should stick with. Master that one first before you jump onto another. So anything else I want to say about the order flow behind these, differences, challenges, order that you should practice this? I think I've covered most of it for now. So let me move on to the sizes of corrective structure. So we have three sizes, and we have a large corrective structure, what we're terming LCS, medium corrective structure, MCS, and a small or tight corrective structure, and that's SCS. So each one of these has a very different order flow behind it. Large corrective structures, you might have heard me use this term, are also known as balancing zones. It's where the market is balancing between a resistance and a support. And there's enough activity on both sides of the market that they're kind of saying, hey, we have an equal agreement here in terms of a relatively equal agreement in terms of value. I think it shouldn't be more expensive than this, and I think it should be cheaper than this. And we're kind of willing to kind of play pong and meet somewhere or agree somewhere between those 2 points. So there is the greatest amount of presence of both sides of the market in large corrective structures. And what that also means is that gives you, to some degree, a relatively balanced opportunity to make money and both sides of the market. In fact, you should be playing both sides of the market in these structures. And so usually there'll be a lot more material signs in the price action that that large corrective structure is breaking. We've talked about this many times before, but with that being said, you want to be playing these both sides of the market as much as possible. If you have 1,000 corrective structures and 1/3 of them are large, you want to be playing the majority of those large corrective structures 90% of the time on both sides of the market. So that's the underlying basis of the order flow behind them. Medium corrective structures are not these huge zones. They're more stable for like a few days, weeks, maybe a couple months maximum, and you have to, we can't hold me to a definition on that fixed number. Just kind of think of it in a relative term. Medium corrective structures can be due to events or holidays, or they can just be to the market needing a little bit of a pause before it starts the next run again. Whereas large corrective structures can be for months, maybe years, and we're going to go over some examples of that. And there are some major differences in terms of opportunities between them. Medium corrective structures, you want to be trading more with trend than that one versus counter trend. And ideally, when you are trading medium corrective structures with trend, if you ever have a doubt as to which direction that is, because a medium corrective structure may or may not always be in a place where it looks like it's going to continue with trend, or the trend is totally clear. With that being the case, whatever the direction was of the impulsive move that led into that corrective structure, that started that medium corrective structure, then stick with that, just to be on the safe side. You can still play both sides on these, but you have to understand that the time expiration on them is faster. They will expire faster than the large ones. And so you have to be a little less patient with them, and a little more just ready to act on those, because they oftentimes won't last as long as, these large corrective structures that you see out there, and so smaller tight corrective structures, these are mostly things that you find on intraday, or if there is 2 super small daily candles back to back, then for that time period it's a smaller tight corrective structure. In terms of the order flow, this is the one with the least amount of two-way order flow. The very existence of a smaller tight corrective structure suggests that whoever was dominant moving into that and creating that small tight corrective structure is still in control, because they just made a push forward and the other side of the market hasn't pushed back at all. It's just kind of a very, very small movement towards, with trend, horizontal, or counter trend, but regardless, it's the least amount of two-sided order flow. And so these, you want to be trading the majority of these you want to be trading with trend. A higher percentage than the median corrective structures. Median corrective structures, you can have a little bit of a balance, but more towards one side. Small corrective structures, you want to have the most amount of imbalance in terms of trading with trend versus counter trend. So there are varying examples of order flow environments that will produce small corrective structures, very small amounts of profit taking, holidays, consolidations before events, a dropping of liquidity, people waiting for certain things to kind of happen before, in between sessions. There's a lot of reasons that these can be created. The majority of them really offer us opportunities to get into the market with smaller stops. And so we don't want to treat small corrective structures as huge support or resistance zones. They expire super fast. So they expire the fastest of all of them. So you should be seeing a progression here in terms of expiration and order flow differences. They both, are on a spectrum. And other thing I want to say is they also have varying levels of structural support. So large corrective structures have the opportunity to provide the thickest amount of support because both sides of the market are in relative agreement. Medium corrective structures will offer support, but not as much. So if there is a penetration into them, it's not going to be able to, like once it gets to a certain depth, then that structure is broken. Whereas a large corrective structure can be penetrated with a little bit more depth before it gives up. So before that structure is no longer valid. And there's no perfect answer for that. My general rule is about 10 to 25%, on the low end 10%, and on the high end 25%, that once a structure gets violated by that much, it's kind of that structure is no longer important. It's no longer meaningful, so we just kind of have to forget it at that point and let it go. Anything else I want to say about that? Okay, let's move to some charts. Okay, so you're a dollar perfect example right now. After a very long down move for a couple of years from 35 down to 05, we've been balancing in a large corrective structure, a large balancing zone between 105 and 117, 1200 pip range. So this is a large corrective structure. It's got a couple touches on both sides of the market by and large. Large corrective structures tend to come after very, very big moves because they've, the reason being is that the further the trend goes in one particular direction, the more it's going to attract the other side of the aisle. The more it's bearish, the more it falls. As time goes on and that progression goes on, interest from the bulls will increase, and vice versa. For an uptrend, the farther and farther a trend goes to the upside, in terms of time, is that the other side of the market will get interested. It's not that they may be willing to step in front of that trend, but their interest gets more piqued the more expensive or the more cheap something gets. In reality, any trend is one currency getting cheaper versus another. So when things get really, really cheap, that's when people start to get interested. And that, again, that doesn't mean that, because if you think about a trend, the deeper the trend goes, the deeper the order flow is to one side of the market. So that's the order flow behind it. But that doesn't have to do anything with interest. There is just a belief in the brain that moves towards balance, homeostasis, and kind of an equilibrium or reversion to the mean, as they call it. And so eventually we will gravitate towards balance, and thinking the farther this goes in one direction, the more imbalance it is, and it needs to come back to center. So that's part of the reason why large balancing structures or zones happen after big, big, big moves. And most often, the largest balancing structure in the entire move, if it is the last structure in that entire move, that has the highest probability of being the reversal, or what was often termed as redistribution. So it's the end of that trend where the order flow gets distributed from one side to the other, strong to the weak hands, and then the market starts to reverse. If we look at the next one, this is another example of it, and it's one that we talked about ahead of time, saying, hey, I'm expecting the dollar yen to break to the downside. I initially I was bullish for the first half of this year, but then as the market started to weaken, I started to say, wait a minute, dollar yen's, this is probably the end of it. So dollar yen was a great example of the largest structure in this entire series was the end, and that was the place where the market reversed. Let's look at some medium ones here. Silver on the 4-hour chart is a great example, between 19.25 and 20.75. So it's about an 8% range. It's 8% of the entire value. You can see a lot of smaller structures, but this is the medium one right now. So I don't think this is the end for silver. It's a horizontal structure. It's very favorable. It's not too wide. I don't think it's the end for silver. Even if it breaks the structure, I'm still bullish on silver. So, but that's a medium one. Let me give you another medium one. Aussie yen, big down move, counter trend impulsive bounce, took out this prior swing high, and then started to consolidate into a medium-term corrective structure. So that would have means that you could play both sides of the market, but if you had to choose and have 60 trades on one side and 40 on the other, you'd want to be on the buy side. Why? Because the move that was the one that preceded the structure itself was impulsive in this direction. And you pile that onto the fact that it took out this prior swing high, those two things alone should be saying, okay, if I take 60 trades, they have to be on the buy side and 40 are on the sell side. So, anything else about medium term? No, I feel pretty cool about that. Small corrective structures, least amount of presence in the other side of the market. These are the ones you want to attack the most with trend. These are some really good horizontal, a little more choppy. In fact, this one started off corrective counter trend, and then kind of stabilized since then. So that is some small corrective structures right there. I should have another one there. Yeah, pound on the 5-minute chart. And these structures form on any instrument, any time frame, any environment. Doesn't matter. FX futures, indices, options, you know, in terms of, I mean, well, options is off of charts and prices anyways, but commodities, the whole thing. Doesn't matter. Bonds, happens on any instrument. So don't feel like this is isolated. I'm just kind of showing FX charts in this case here. So small corrective structure, horizontal, small corrective structure, initially horizontal, then it starts to produce what? Pre-breakout formation. So, and what do I say about these? These are the least trustworthy overall. That doesn't mean we shouldn't be trading them. That doesn't mean we can't make money off them. But they offer the least amount of structural support. So that means we should be most impatient with these trades and smallest stops on this one here. Okay, moving forward towards the end of part one. So size of the structure determines structural support. This is what we talked about in terms of the level of order flow that's going to defend that structure and the boundaries of that structure. So I think I've covered this already. I kind of jumped ahead, but I did cover this. So just kind of think of it that way. If the market is testing a major, large corrective structure, expect that to hold for a longer period of time. Medium ones, a little less time, and short ones, the least amount of time. Can money be made on using any of them for structural support or resistance? Yes, absolutely. We just have to understand that the expiration on that is either more or less. Okay, that's 22 minutes, and I kind of powered through that. So that's large and small corrective structures part one. I will probably do part two, maybe September or something like that. Because in August, the end of this month, we have exhaustion price action. So I'm looking forward to getting that one out to you guys. And some final details and things I want to put together in that. But that one's pretty cool, pretty close to go. So we'll do that end of August. And then other than that, I look forward to your comments and questions on this. Make sure to comment below what you got out of this. And also do comment, you know, what questions you have about this. What do you feel like you understand and don't understand? And, you know, let's evolve and enhance and amplify the discussion on this. So I'll look forward to hearing from you, and I will see you inside the course.